Kelly's criteria and the common questions answered. We got so many questions that we asked the research team, you know what? Let's have a little fun with this. Let's just answer a bunch of questions. Go ahead, John. Next slide. So we received numerous emails with questions about the Kelly's analysis that we did to help traders who want to apply this methodology but aren't familiar with the concept. We've compiled the most common questions with our answers. All right? Here's the formula. Let's go to the next slide. Here we get into the questions. So the first question is there a quick way to determine if a strategy can be profitable long-term based on Kelly's calculation? So, and of course, the research team did this to me just to torture Tony and myself. If we can set F to 0 as the threshold in this formula and evaluate whether we received odds, our received odds exceed the theoretical requirement for a given pop or success rate. In our Iron Condor example, let me just go through this really quick. Looking at this formula here in the Iron Condor example.
Well, that's the simplified formula, Sosnoff, as you know.
I know, but I'm just trying to go through the winning rate and the losing rate. The odds must exceed point. This is interesting because essentially what they're saying is you can plug in the success to get to a long-term success rate. You can plug in the numbers and then you can play with the numbers until you get to a long-term where you get to a positive number to tell you if you'll be profitable in the long run. And it looks like in this case, you got to get to that 85% number.
That's correct.
That's why in our previous example, when the odds are greater than 0.176, the strategy should be able to see a positive Kelly and as a result, a positive long-term performance. When managing positions at 50% profit, should I reference POP or P50 on the tastytrade platform? What about managing at 21 DTE? The P, which is the probability of profit in the Kelly calculation, should match the way we manage our positions. If the position is managed at 50% winners, P50 is better than POP. However, the realized success rate is even more accurate than the theoretical POP or the P50. Traders can find the success rate of managing in 21 days or any other mechanics by running the look-back program on the tastytrade platform or from our market measure. So the probability of profit, the P, which is probability of profit, that's the POP, in the calculation of Kelly should match the way we manage the positions. If the position is managed at 50% winners, the P50 is better than POP. Okay, that's interesting. I don't really do it that way, but that's interesting. Let's go to the next slide. Does the Kelly number change based on the fluctuation of the bankroll, which means the net lick in your account? And the Kelly represents a percentage of capital allocation of a certain portfolio. In our analysis, we keep this number constant, but the net lick can fluctuate after trading. Keeping the Kelly at the same level, we should expect to see more committed capital per trade if the net lick increases. I think that's the way we do approach this business all the time.
Sure.
We increase capital committed if our net lick increases. Let's go to the next slide. I need clarification on how the payout and odds are calculated. How are the net odds received calculated? Okay, this is what I didn't understand from the prior slide. So this morning, we looked at XSP Iron Condor. The POP was 50, the P50 was 72. The max profit, the max loss, assume I take profit at 50%. P&L is B.5. Let's go to the next slide. Check out how the odds are calculated. A, the odds are the expected win divided by the expected loss. Okay, that makes more sense. It's better to use the realized average win versus average loss in this calculation. We get these values after analyzing the long-term data. Using the max profit or the max loss is not as reliable because the premium selling strategies, we often experience partial winners and losers. So for probability, we should either use the P50 or the realized success rate when managed at 50% winners. The odds are the expected win divided by the expected loss.
Does that clarify it for you? Does it make it any better or worse?
Because the expected win, yeah, it does. So the expected win is 50% of max profit. So if you sell something, let's say for $1, the expected win is 50%, right? So you divide that 50% by whatever the expected loss is, which is just, let's say, in the case of an undefined risk trade, it's 2 times, right? So the expected loss, let's just say, would be $2, and the expected profit would be $1, would be 50 cents. Then your odds would be 25%, right? Is that right?
Half of the 50%, sure. Mm-hmm.
Okay. So if you collect $1 in premium and you expect to make 50%, then your odds would be 25%. Which is actually what makes sense. Let's go to the next slide. You used an iron condor as an example, but how do you adjust for jade lizards and strangles? As long as we have the pop, or the success rate, and the B, the average expected win-loss, we should be able to calculate the Kelly number. These inputs for most option strategies, including jade lizards and strangles, are already known. We don't necessarily do this, but I guess we're showing you from the retail side, essentially how you could use it. Because Tony said before, could you use this for options or is it just for stocks? And the argument our research team is making is, sure, you can use it for options strategies,
sure,
as much.
Sure.
But it's not as simple, obviously, as you can see.
Yep.
Let's go to the next slide. You mentioned the ruin rate at 0. Does that mean the strategy is completely safe from losing all capital? Theoretically, if the Kelly number is positive, traders should be able to avoid depleting their capital. However, perfect sizing is difficult to achieve in real trading. Also, a streak of losing events is possible. These could cause the portfolio to achieve expected return in a longer period of time, but normally we show the median or mean return by running between 100 and 1,000 trials in a Monte Carlo simulation. Yeah, it always scares me when we say the risk of ruin is 0, because I never understand that myself, but I guess that's just a statistical thing, because it shows up 0 in between 100 and 1,000 trials. On the Tasty platform, we do use Monte Carlo simulation for our P50 numbers. So it's all integrated. Let's go to the next slide.
Yep.
What's the importance of using a fraction of calculated Kelly in real trading? I don't know who's getting these questions because I'm not answering these. Maybe you are. I have not been answering these. The Kelly number, what we call full Kelly, is the scenario to optimize the return without considering the volatility. In the following example, the half Kelly, 50% of the full Kelly, can capture nearly 71% of the optimal returns, only 38% of the volatility. Yeah. I don't really understand that. Let's go to the next slide. That's too hard for me. So in the sample below, with no stop loss control, we tried various Kelly fractions from 25% up to 100 by running Monte Carlo simulations. So this is the final part to that last question. And we looked at the various multipliers, and the 50% number that we use tends to be what we highlighted in green here as optimal.
And I'm being told ruin means your count goes to 0.
Yeah, it does. That's what it said in there. Your count goes to 0. But I don't understand, it makes me nervous to say that there's no risk of ruin ever.
Sure.
Again, I don't fully understand it, but the reason it says that is because in the Monte Carlo simulation, it comes up as 0. Let's go to the last slide.
You're getting pretty deep in the weeds here, Sadnoff.
Yeah, this is very difficult for me. I was wondering how to use Kelly's approach to explore an optimal portfolio of option strategies for maximal profit. That's what Tony asked before. Does Kelly consider only one strategy can be applied to multiple positions? And right now, we only use Kelly to analyze one strategy at a time in a portfolio of without other positions. Multiple positions can impact the results significantly, such as the ruin rate. Analyzing a basket of strategies is much more complex and more complex than we are trying to solve in the near future, or maybe we can.